here with me, and this is Primary Energy. All right, so can you tell me specifically what Primary Energy is?
Sure. Just to start, my name's Joe Powell. I went to undergraduate school at Indiana University, majored in accounting, and went to graduate school at Northwestern up in Evanston. So, Primary Energy is a company that would be defined as an independent power producer. What we do is we create energy and steam and hot water for the steel mills down in Gary and East Chicago, Indiana.
Okay.
Type of business, it's an industrial company. These are big industrial facilities that produce power and steam and heat. Each facility, we have 5 different facilities. Each facility cost about 150 to 200 million when they were initially built back in the 90s. So do you want to ask me these questions, or should I just go?
Yeah, I can ask you a question. I was just letting you flow. How you
right,
flowing?
fair enough. So
we're on number 4.
Yeah.
Number 4 is Primary Energy a corporation or a partnership, or?
Yeah, so we're organized as a limited liability corporation, which is a sort of a derivative of corporation. We do have partnerships in our underlying structure that consolidate up, but at the higher level companies, it's organized as a limited liability company. Whether it's a public or private company, right now it's a private company. We were a public company for about 10 years, from 2005 until 2014. And then we were taken private by a private equity consortium, and that's the type of company that we sit in today.
Okay. What service does Primary Energy provide?
Yeah, so going back, so we actually provide energy and steam to the steel mills down in Gary, and what the business model is we take the heat that is created from their manufacturing process. When they make steel, there's huge, massive amounts of heat that they normally would just let go up into the air. Our facilities capture that heat, use it to create steam, and pressurize the steam and run it through steam turbines that spin at high rates of speed and create electricity through electric generators. And then we sell that electricity and the steam back to the steel mills. And so it's a win-win for us, because we're taking a byproduct of their manufacturing process that wouldn't have any value, and we're turning it into value. It's also a very environmentally friendly business, because we don't burn any additional fuel to create this electricity. We're taking this byproduct and turning it into electricity. So our company's very environmentally friendly from an emissions standard as well. So.
So from the accounting aspect, how would you necessarily record that on the financial statement? Yeah, so we sell our energy and steam to the steel mills under long-term contracts. So these contracts are anywhere from 10 years to 15 on up. And so there really isn't a sales function of the business. It's our contracting aspect that generates the revenue from the business. And so for every megawatt of energy that we deliver to the steel mills, we get paid X amount of money. And generally it's in a tiered billing structure where you produce a block of power, you get billed at a certain rate, and the next block of power gets billed at a separate rate. Same with steam, same with hot water. So we record that activity in the financial statements as our revenue, and then we actually incur operating expenses to keep these machines running on a daily basis. They operate 24/7, 365 days a year, so there's an awful lot of effort put into the maintenance and operation, and there's some cost associated with that, and we record those costs as our operating expenses. Okay. I wasn't sure if there's any way, or if you have any internal control policies, or how does that work?
Yeah, so from a financial statement perspective and an accounting perspective, we really focus on making sure that we have segregation of duties, meaning that one person creates a journal entry, for example, a second person reviews and approves it before it's posted to the general ledger system. And then from a cash or economic perspective, one of the things that we do from a control perspective is centralize the payment activity here in our corporate headquarters. So the plants incur the expenses, they send the invoicing up to corporate, they review the invoices and approve them for payment, it comes up to corporate and we process them for payment, and the cash transaction actually transacts out of our corporate office. And then beyond that, in terms of trying to make sure we have controls to validate our accounting records and our financial reporting, we use what are called account reconciliation process on a monthly basis as part of our close, and those are analysis and support that validate the accounting journal entries that are being made and the accounting balances that are reflected in our general ledger, and those are the balances that ultimately roll up in our financial statements.
Okay. And then the last two accounting principles that I had?
Yeah, so from a revenue perspective, because as I mentioned, we're structured with these long-term contracts, our revenue actually flows underneath the lease accounting standards. It's fairly complex, but we're deemed to be the leasor of our equipment to the steel mills because, for a lot of reasons, but the primary reason is because they take all of the outtake out of this asset that we're using. And so under that premise, we fall under lease accounting. We record our revenue as lease revenue. A couple other accounting pronouncements that we deal with on a regular basis are deferred taxes. Our financial structure was set up as a public company to generate pretty large and substantial net operating losses from a tax perspective over the course of our time horizon, and so from that standpoint we have pretty significant deferred tax accounting work that we do. The other accounting pronouncement that is probably a little bit paramount is accounting pronouncements around financial instruments. So our company has approximately $200 million of debt, and as part of that debt process to manage our cash flow relative to the interest rate, we have what are called interest rate swaps, which are derivative transactions that fall under financial instrument accounting. A little bit sophisticated, but once you get it set up, it just kind of flows, and we mark those derivatives to market every month so that they're stated at fair value, and that flows through our financial statements as well.
Okay. I appreciate your time and you taking your time out of your day to sit down with me and interview with me.
Sure thing, Jordan, anytime.
All right.
Good luck.
All right, thank you.